Let us now continue with problem 6-18. On January 1, 2022, Louis Yang Company issued 3-year bonds payable with face amount of 5 million at 98. Additionally, the entity paid bond issue cost of 140,000. The nominal rate is 10% and the effective rate after considering the bond issue cost is 12%. The interest is payable annually on December 31. The entity used the effective interest method. Okay, so the main difference of this problem in the other problems discussed in the earlier videos is that we are now dealing with bond issue cost. Okay, just remember that your bond issue cost will also have to be amortized. So this will be offset against your premium or discount. Okay, but to simplify the treatment class, just deduct the bond issue cost from the price to arrive at your initial carrying amount. Okay, and the good thing with this problem is that we are already given with the effective interest rate that already took into account the bond issue cost. So the challenge on your part would simply be to determine the initial carrying amount. Okay, and to do that, simply deduct the bond issue cost from the price of the bond. Okay, so the face amount of the bond is 5 million, but it was sold at 98, and that should give you the price. You multiply 98% with 5 million, you would get a price of 4,900,000. Okay, and then you deduct the 140,000 because even though you sold it for 4,900,000, since you paid for bond issue cost of 140, the net amount of money that you would get would only be 4,760,000. And this is now your initial carrying amount. And this would be the big challenge, the main challenge for you in this problem. Okay, if you will be able to get the initial carrying amount. So the first question here should be how much is the initial carrying amount of the bond, and our answer would be 4,760,000. Okay. The next question is how much is the carrying amount of the bonds payable? Okay, so assuming this is the only question that we have to solve, how should we approach this one? Okay, you try to recall our formula for your carrying amount. It is the face value minus the unamortized discount or plus the unamortized premium. Okay, in this case, let's just lump together our discount and our bond issue cost. Okay, let's just treat them as one single figure. Okay, so if our initial carrying amount is 4,760,000 and the face amount is 5 million, okay, let's say that the discount together with the bond issue cost amounts to 240,000. Okay, now our answer for December 31, 2022 would not be 4,760,000 because we expect the discount, the initial discount of 240,000 to decrease by the end of the first year. Okay, and that is why if you look at the choices are greater than 4,760,000 because of the decrease in your discount. Okay, so basically the question is for carrying amount, but to solve for the carrying amount, we need to determine first the updated balance or the remaining or the unamortized discount. Okay, and how do we get the remaining discount? First, we have to determine the amortization for the year. Once we get the amortization for the year, we deduct that from the initial discount. Again, how much was the initial discount? 240. Okay, you start with 240 and then you deduct the discount for the year or the amortization, the discount for the year you would get the updated discount. Once you have the updated discount, uh, you can now solve for the carrying amount. Okay, we're looking for the carrying amount, but we cannot solve for the carrying amount without the updated discount. We cannot get the updated discount without first solving for the amortization for the year. Now, how do we solve for the amortization for the year using the effective interest method? We compare the interest expense with the fixed interest payment. Okay, so that means we need to solve first your interest expense. It's easy for us to determine the fixed interest payment. Okay, but aside from the fixed interest payment, we need the interest expense to get the amortization, and we need the amortization to get the remaining discount, to get the unamortized discount, for us to ultimately solve for the carrying amount. Okay, so what I'm saying is the question is for carrying amount of the bonds after 1 year, but to answer that one, we need the remaining discount, we need the updated discount, we need the unamortized discount. For us to get the unamortized discount after 1 year, we need to solve first the amortization on the discount for the year. How much then is the change or the decrease in the discount for the year? And for us to get the amortization on the discount, for us to get the change on the discount for the year, we need to compare the interest payment and the interest expense. And that would mean we will also need to solve for our interest expense first. So basically, even though there's only one question here, we would actually still be answering all the 4 questions that we normally solve uh, as we answer the other problems. Okay. So, but I hope you understand the flow. First, we need the interest expense. And how do we solve for the interest expense? You multiply it with the previous carrying amount. And since this is the first year, our previous carrying amount would simply be the initial carrying amount. And our initial carrying amount here is 4,760,000, as mentioned already earlier. Okay, and you multiply this with the effective interest rate. And how much is the effective interest rate? It's 12%. So you would get an interest expense of 571,200. Okay. Again, I hope you're still able to follow that we are doing this for us to solve the carrying amount. Okay. There's a process or a flow to the computation of the carrying amount. Okay. Once we have the interest expense, what do we need so that we can get the amortization? You compare the interest expense with the fixed interest payment. How much is the fixed annual interest payment in this problem? Okay, you get that by multiplying the face amount of 5 million with the nominal or stated rate of 10%. Okay, so the fixed interest payment is 5 million times 10%, you will get 500. So that would mean that the amortization on the discount, the additional interest expense arising from the amortization of the discount would be 71,200. And how did we get that one? The difference between the fixed interest payment of 500 and the interest expense of 571,200. Since we already have our amortization for the year, we can already solve for the remaining discount after 1 year. We can already solve for the unamortized discount at the end of the first year. Okay, and how do we do that? We deduct the amortization for the year from the previous balance of the discount. How much was the previous discount? How much was the previous balance of the discount? It was 240. Okay, and you deduct the amortization for the year of 71,200. The remaining discount after 1 year would be 168,800. And with this, we already have what we need to solve for the carrying amount of the bonds. How do we solve for the carrying amount of the bonds? That is the face value minus the remaining discount or the unamortized discount, net of the bond issue cost, 5 million minus the 168,800 we solved earlier. The carrying amount after 1 year would be 4,831,200, and that would be your Bravo. Alternative solution, uh, we begin with the previous carrying amount, in this case, the 4,760,000, and then you simply add the amortization, the discount for the current year, which was 71,200. You would still get 4,831,200. Okay. In your own time, class, practice with this problem and expand it uh, up to the second year. Okay. And also, maybe we will use this problem to point out the difference between the straight line and the effective interest method. Try answering the same set of questions using the straight line method. Okay, let's proceed to problem 6-19. On January 1, 2022, Caro Company issued 10% bonds payable with face amount of 5 million, which mature on December 31, 2031. The bonds were issued for 4,430,000 to yield 12%, resulting in bond discount of 570,000. The entity used the interest method. Interest is payable semi-annually. Okay, this is nothing is tricky with this problem, except that unlike the previous problems we have solved, the interest payment now would be semi-annually. Okay, and this would just mean that the process would be longer. Okay. Now, first is how much is the interest expense. Again, remember that the interest expense is simply the carrying amount of the bond multiplied with the effective interest rate. Okay, but very important thing to remember, because if it is semi-annual kasi, you will have to do the you will have to amortize the bond twice for you to be able to get the total interest expense for the year. Okay, so what do I mean? First, you will need to amortize on June 30, the first interest payment date, and another amortization on December 31. Okay, so it's very tempting, class, to answer this one. Some of you might simply decide to multiply 4,430,000 with 12%. Okay, let's try that one. 4,430 times 12%. Okay, and you would get 531,600, and that would be very tempting, especially that it is in the choices. Okay, but the 531,600 class is incorrect because you are you are simply computing it as if the interest payment happens annually, but that is not the case. Okay, but it begs the question: are we supposed to be computing only for interest expense for 6 months? The answer is no. You will still need to compute interest expense for 12 months, okay? But you will have to compute for interest expense twice for you to get the interest expense for 12 months, okay? So think of it as the previous problems we have solved, wherein we solved for year 1 and year 2, okay? Think of that problem, but instead of that solution being for 2 years, think of it as our solution for 1 year. So if you are solving for the interest expense for 1 whole year, the interest expense we computed for year 1 added with the interest expense we computed for year 2, you add those two, then that would be your total interest expense. It is wrong for you to simply multiply 4,430,000 4,430 with 12%. Okay, but we'll demonstrate this one. First, let's solve the interest expense for the first 6 months. Okay, we will still be using 4,430,000. Okay, but instead of multiplying it with 12%, we will just multiply it with 6%. Okay, and this would give us the interest expense. This would give us the interest expense for the first 6 months. The problem with the effective interest method class is that your interest expense every period will not be the same. Okay, so uh, your interest expense for the first 6 months would be different from uh, the interest expense in the second semi-annual period, or the next 6 months, or the third 6 month period, or the fourth 6 month period. That is why you cannot simply multiply the previous carrying amount with the annual rate. You will have to do it per interest payment period. Okay, so that's why we do not like problems with semi-annual payment, because it makes the solution process lengthier. Okay, but again, let's answer this one. Interest expense for the first 6 months is 265,800. Okay, and we will have to go through with our entire process class so that we would know how much then is the carrying amount after the first 6 months, so that we can now use that one to solve for the carrying amount, sorry, to solve for the interest expense for the next semi-annual period. Okay, so our interest expense for the first 6 months is 265,800. Next is solve for the amortization and the discount for the first 6 month period. Okay, and how do we do that? Compare interest expense with the fixed interest payment. How much is the fixed interest payment? Stated rate is 10%, so that means every 6 months it's 5%. Multiply 5% with 5 million, you would get 250,000. You will now compare that 250,000 with the interest expense we have computed earlier of 265,800. That means the amortization for the first 6 months would be 15,800. And this 15,800 will be used to get the updated discount, to get the unamortized discount. How much was the beginning balance of our discount? It was 570. Okay, and then how much is the amortization this year? It is in the first 6 months, it's 15.8. So 570 minus 15.8, you would get 554,200. Okay, you would get 554,200. And then once you have the updated discount, you can already get the updated carrying amount as of June 30, 2022. Okay, and how do we get the carrying amount? Okay, it's face value minus the updated balance of the discount. So 5 million minus the remaining discount after 6 months of 554,200. You would get 4,445,800. Now you would ask, why do we need to solve for the carrying amount on June 30, 2022? Because we will be using the 4,445,800. We'll be using the carrying amount as of June 30, 2022 to solve for the interest expense for July to December 2022. Okay? Remember that the formula for our interest expense class is the effective rate multiplied with the previous carrying amount. So every time there's an amortization, there will be an updated carrying amount. Okay, so if you want to determine the amortization for 4 periods away, then you will have to keep on updating it. You will have to keep on amortizing and updating the carrying amount 4 times. Okay, and that's what we're doing here. Okay, you will have to go through this process, guys. Okay, so the carrying amount then on June 30, 2022 of 4,445,800 would be the basis for the interest expense for the next 6 months, for the second 6 month period. Okay, so this would be, I am now solving for the interest expense for the second half of 2022. So that is 4,445,800 times the effective rate, but again, just 1/2 of the effective interest rate, which is in this case 6%. So 4,445,800 multiplied by 6%, you would get 266,748. What is this 266,748? This is the interest expense for July to December. Okay? And what have we solved earlier? We were able to solve for the interest expense for the first 6 months, meaning the interest expense for January to June, which was 265,800. And since we were able to compute for the interest expense for January to June and July to December, we already have the total interest expense for the year 2022. Okay, how much was the interest expense for January to June? It's 265,800. You add that with the interest expense for July to December, which is 266,000. 748, and that would be our total interest expense for 2020. You add those two, you would get 532,548, which is letter A in the choices. Okay. Again, common wrong answer here would be 531,600, which was solved by simply multiplying 4,430,000 by 12%. Second question, how much is the carrying amount of the bonds payable on December 31, 2022? Okay. Let's just continue with our flow class. We've already computed that the interest expense for the second 6-month period is 266,748. For us to get the carrying amount after the second 6-month period, we will have to update the discount. And for us to get the updated discount, we will have to compute for the amortization of the discount for the second 6-month period. Okay, we already have the interest expense for the second 6-month period. We just have to compare it with the fixed interest payment of 250, and that would mean the amortization on the discount for the second 6-month period would be 16,748. So if the amortization on the discount for the second period is 16,748, how much then would be the remaining discount? How much then would be the unamortized discount? Okay. After the first 6-month period class, the balance of the discount was 554,200 minus the additional amortization during the second half of the year, which is 16,748. The remaining discount would be 537,452. And this would be the amount that we will use to solve for the carrying amount after the end of the year. Okay, so 5 million face amount minus the updated balance of the discount, the unamortized balance of the discount of 537,452. The carrying amount would be 4,462,548. And then alternative solution, just get the previous carrying amount, which was 4,445,800. This is the carrying amount as of June 30, 2022. And then just add the amortization of the discount during the second half of the year, which is 16,748. And that will still give us 4,462,548. Okay, so you can actually just go back to our discussion on problem 6-17 and 6-16, wherein we expanded the problem to include year 2. It's basically the same class, except that we will be merging year 1 and year 2. Okay, I hope you're able to get this problem. Let's proceed to 6-20. On January 1, 2022, Masbate Company issued 5-year bonds payable with face amount of 5 million at 100 debt. The entity paid bond issue cost of 80,000 on the same day. Okay, again, let's just get the initial carrying amount by deducting the bond issue cost from the price. The stated interest rate on the bond is 8% payable annually, so at least it's annually class. It will not be as tiresome as problem 6-19. Expect problem 6-19 to come out in the exam. The stated in the bonds were issued to yield 6% per annum after considering the bond issue cost. The entity used the effective interest method. On December 31, 2022, what is the carrying amount of the bonds payable? As I have already explained in problem 6-18 class, even though the question is only for the carrying amount, we will have to go through the entire process because we will need the updated premium or discount, we will need the amortization on the premium or discount, and we will need the interest expense to solve for the carrying amount of the bonds payable. Okay. First, solve for the interest expense. Okay. Interest expense is simply the previous carrying amount multiplied with the effective interest rate. Since we are dealing with the first year, the previous carrying amount that we'll be using would simply be the initial carrying amount. First, determine the initial carrying amount. The selling price is 110% of the face value, so that would mean 5,500,000. But since there is a bond issue cost that we paid for amounting to 80,000, the initial carrying amount would be 5,420,000. So that means the bonds were issued at a premium of 420,000. Okay, and to solve for the interest expense, simply multiply the initial carrying amount since we are on the first year with the effective interest rate of 6%. So that's 5,420,000 multiplied by 6%. If you are asked how much is the interest expense, the answer here would be 325,200. What's the next step? Solve for the amortization and the discount. Or the premium. How do you get the amortization and the premium and the discount? Compare the interest expense with the fixed interest payment. How much is the fixed interest payment? That is simply the face amount of the bond multiplied by its stated rate. How much is the stated rate or the nominal rate? It's 8%. So 5 million times 8%, you would get 400. Compare 400,000 and the interest expense of 325,200, you would get a difference of 74,800. The 74,800 will represent the amortization on the premium. Since we already have the amortization of the premium, we can now solve for the updated balance of the premium or the remaining premium or the unamortized premium. How much was the initial balance of the premium? It was 420,000, the excess of the initial carrying amount from the face value. So 420 initial premium minus the amortization of the premium for the first year of 74,800. The remaining premium or the unamortized premium after 1 year would be 345,200. Okay, and with this we can already solve for our carrying amount. Okay, since we have a premium, what's the rule here? The unamortized or the remaining premium will have to be added with the face value. The face value is 5 million. You add this with the remaining premium after 1 year, which is 345,200. Our answer here would simply be 5,345,200. Alternative solution, instead of starting with the face amount, we begin with the previous carrying amount. How much is the previous carrying amount? Or in this case, the initial carrying amount is 5,420,000. And what do? We deduct the amortization for the year. How much was the amortization on the premium for the year? It was 74,800. So 5,420,000 minus the amortization of the premium of 74,800, you would get 5,345,200. Okay. Please take note of the difference kasi if we're dealing with the discount using our alternative solution, the amortization is added. If we're dealing with a premium using our alternative solution, the amortization would be deducted. Okay, just remember, class, that through the amortization, the carrying amount of the bond will slowly move towards its face value. So if it's at a discount, it will slowly go up towards its face value. If it is at a premium, it will slowly go down towards its face value. Okay, let's proceed with problem 6-21. On January 1, 2022, Bontoc Company issued 5 million 8% serial bonds payable to be repaid in the amount of 1 million each year. Interest is payable annually on December 31. On December 31. The bonds were issued to yield 10% a year. The bonds were issued for 4,757,000 based on the present value of present value at January 1, 2022 of 5 annual payments. The entity amortized the discount on bonds payable using the interest method. On December 31, 2022, what is the carrying amount of the bonds payable? Okay. First, let's solve for the interest expense. How much is the interest expense? It's 4,757,000 times the effective or the yield rate of 10%. Okay. Initial carrying amount is 4,757,000. Multiply that with, this is annually, multiply that with 10%. Our interest expense is 475,700. And then we need to compare that with our interest payment. How much is the interest payment here? The previous balance was 5 million and the stated rate is 8%. Okay, so 8% of 5 million, you will have 400,000. Okay, but in this case, class, I want you to add the principal payment of 1 million with our interest payment of 400,000. Okay, aside from paying 400,000, how did we get the 400,000 interest payment? That's the balance of 5 million multiplied by 8%. Okay, but aside from paying interest, we'll also have to pay the principal of 1 million. So the total payment on the first year would be 1,400,000. Please take note, this is what makes this problem different from the others. There is a periodic payment on the principal. Okay, so total payment on the first year is 1,400,000. Okay, the 1 million is to be applied to the bonds, the balance of the bonds payable. Okay, 1,400,000 total payment, and the interest expense for the year is 475,700. Okay, so out of our total payment of 1 million, out of the total payment that we will be making, out of the 1,400,000 total payment, 475,700 of that will be applied to interest. Okay, so you get the difference, 1,400,000, and then deduct 475,700. That means the balance of the note or the balance of the bond will be reduced by 924,300 by virtue of the 1,400,000 we are paying. Okay, so look at it this way: you are paying 1 million to be applied to the principal, but because your actual interest expense is greater than your interest payment. How much is your interest payment? 400,000. How much is your interest expense? 475,700. Because your interest payment is lesser than your interest expense, a portion of your 1 million principal payment will be paid first to interest. So if you will be asked, how much of your total payments, how much of your 1,400,000 payment will be applied to the principal? It will just be 924,300. And how did we get that one? Total payment of 1,400,000 minus interest expense of 475,700. How did we get the 1,400,000? The principal payment of the supposed principal payment of 1,000,000 plus the interest payment of 400,000. How did we get the interest payment of 400,000? That's 5 million minus times 8%. Okay, so it is this 924,300 that will be deducted from the previous carrying amount. How much is the previous carrying amount? It's 4,757,000 minus the principal payment of the minus the portion of the payment to be applied to the principal of 924,300. You will arrive at 3,832,700. So the carrying amount on December 31, 2022 will be 383,002. 3,832,700. Okay. Let's proceed to 6-22. On January 1, 2022, Arrow Company issued 10% bonds payable with face amount of 5 million that mature on December 31, 2026. The bonds were issued for 4,632,000 to yield 12%, resulting in bond discount of 368,000. The entity used the interest method of amortizing the discount. Interest is payable on June 30 and December 31. For the year ended December 31, 2022, what amount should be reported as bond interest expense? So basically, problem 6-22 is similar to problem 6-19. Okay, so maybe either 6-19 or 6-22 will come out in the examination. Okay, we're solving for interest expense. Again, it will not just be 4,632,000 times 12%. We'll have to go through two amortizations. Okay, first let's work on the amortization for January to June. Okay, the initial carrying amount is 4,632,000. Okay, we will use that 4,632,000 to compute for the interest expense for the first 6-month period. Okay, the first half of the year. Okay, we will be using the effective interest rate. The effective interest rate is 12%, but since we are doing semi-annual amortization, we will just be using 6%, which is 1/2 or 6/12 of the 12% effective rate. So that means our interest expense for the first half of the year is 277,920. This is not yet the answer because this is still the interest expense for the first half of the year. We will have to compute for the interest expense for the second half of the year. Okay, but we can only do that after we have updated the balance or the carrying amount of the bond after the first 6 months. Okay, so we already have the interest expense for the first half. Next, determine the amount of amortization. And how do you do that? Compare interest expense with the fixed interest payment. How much is the fixed interest payment? It is 5 million times 1/2 of 10%. Okay, 5 million is the face value, 10% is the stated rate. But since we are dealing with a semi-annual period, we will just be using 5%. So 5 million times 5%, you would get 250. The fixed interest payment every 6 months would be 250,000. And since our interest expense was 277,920, that means there is an amortization on the discount for the first half of the year amounting to 27,920. Okay, and with this, we can already update the balance of our discount. We can already get the remaining discount or the unamortized discount at the end of the first half of the year. Okay, how much was the initial discount? It was 368,000 given in the problem. How much was the amortization of the discount on the first half of the year? 27,920. Okay, so the remaining discount then after the first 6 months would be 368,000 minus 27,920. We will have 340,080. Okay, and with this, we can already get the updated carrying amount by June 30, 2022. How much was the face value? Is 5 million. And then deduct the updated or the remaining discount or the unamortized discount of 340,000. 5 million minus 340,080, you will have 4,659,920. Just for a while, I'll have to check on something. Okay, so going back, the carrying amount of the bond as of June 30, 2022 is 4,659,920. And it's important for us to solve for this one, for the 4,659,920, because we will be using this one to solve for the interest expense for July to December of the year. Okay, so 4,659,920 times one half of the effective interest rate of 6%. That means the interest expense for the second half of the year, for July to December, is 279,595,000 and 20 centavos. You add this with the interest expense we computed for the first half of the year, you will have 279,595.2 plus the interest expense for the first half of the year, which is 277,920. You would get 557,000 557,515. Okay, the 20 centavo was dropped in the problem. Okay, and since we're already here, class, might as well solve for the carrying amount of the bond. Okay, carrying amount of the bond as of December 31, 2022. We already have the interest expense for the second half of the year. We just need to compare this with the fixed interest payment every semi-annual period, which is 250,000. Okay, the, every 6 months, the interest must be paid in the amount of 250,000. Compare that with the interest expense for the second half of the year, which was 279,595. You will have an amortization of 29,595. Okay, and then with that, you can get the updated balance of the discount or the unamortized discount, which is it was 340,080 at the end of the first half of the year, and then deduct the amortization for the second half of the year. That would be 340,080 minus 29,595. You point two, you would get 310,484.8. And this would now be the amount that will be deducted from the 5 million to get the carrying amount at the end of the year. 5 million minus 310,484.8. The carrying amount after the first year would be 4,689,515.2. Okay. With that, we can proceed to problem 6-23. On January 1, 2022, Nixon Company reported 10% bonds payable with a carrying amount of 5,700,000. The bonds had a face amount of 6 million and were issued to yield 12%. The interest method of amortization is used. Interest was paid on January 1 and July 1 of each year. On July 1, 2022, the entity retired the bonds payable at 102. The interest payment on July 1, 2022 was made as scheduled. What is the carrying amount of the bonds payable on July 1, 2022? This is important because you will be comparing the carrying amount with the retirement price for us to get the gain or loss on the early extinguishment of the bond. Okay, but we already understand to solve for the carrying amount, we'll have to go through the process. With first, we have to compute the interest expense. Okay, the carrying amount is 5,700,000. At the start of the year, it was 5,700,000. You will multiply that with the effective interest rate of uh, 1/2 of 12%, which is 6%, since this is semi-annual. And even though this problem is semi-annual class, this is not a big problem because after the first semi-annual period, the bonds are already retired. So our computation will end after the first 6 months only in this problem. The first 6 months of the year in this problem. Okay. So our interest expense for the first half of the year is 342,000. Okay, and with this we have to compare this 342,000 with the fixed interest payment so that we can get the amortization for the first half of the year. The fixed interest payment would be 6 million times 5%. 6 million is the face amount, 5% is 1/2 of the 10% stated rate. Okay, so 5% is 300,000. Okay, interest payment is 300, interest expense is 342. That means the amortization of the discount is 42,000. With this one, we can already solve for the updated balance of the discount. Okay, how much was the discount at the start of the year? It was 300,000. How did we get 300,000? That's the difference between the carrying amount of 5,700,000 and the face value of 6 million. Okay, so 300 discount at the start of the year minus the amortization of the discount for the first half of the year amounting to 42,000. That means by June 30, 2022 or July 1, 2022, the balance of the discount is 258,000. And this is now the amount that will be deducted from the face value of 6 million to arrive at the carrying amount on July 1, 2022. So we would get 5,742,000. That is the 6 million face value minus the unamortized discount of 258,000. Again, the carrying amount is 5,742,000. And it is alternative solution. We start with the previous carrying amount of 5,700,000, and then you add the amortization of the discount, and we will still arrive at 5,742,000. Now it is this 5,742,000 that will be compared with the acquisition price or the retirement price of the bond. What is the price in reacquiring the bond? It's 102 or 102%. So the face value is 6 million. Multiply that with 102% or 1.02. The retirement price is 6,120,000. How much was the carrying amount of the bond? It was 5,742,000. Okay, the balance of the bond is 5,742,000, but we paid 6,120,000 to retrieve or recover or retire the bond. So that means we paid more in an amount of 378,000. Okay, and that will be the loss that we will be reporting. The answer for the second question here is 378,000. That is the difference of 6,120,000, the retirement price, and the carrying amount of 5,742,000. Okay, let's proceed to 6-24. On January 1, 2022, Moon Company reported 9% bonds payable of 4 million less unamortized discount of 320,000. These bonds were issued to yield 10%. The effective interest method is used. Semi-annual interest was paid on January 1 and July 1 of each year. On July 1, 2022, the entity retired the bonds payable at 103 before maturity. What amount should be reported as loss on retirement of the bonds? Okay, very similar to problem 6-23. First, let's solve for the interest expense so that we can get the carrying amount of the bond, which we will have to compare with the retirement price so that we can compute for the loss on retirement. The carrying amount is 4 million minus 320. That is 3,680,000. Okay, 3,680,000 times 1/2 of the effective interest rate of 10%. 1/2 because this is semi-annual interest payment. Okay, annual effective interest rate is 10%. You get 1/2, you will get 5%. So 3,680,000 times 5%, you would get interest expense of 184,000. Next, after getting interest expense, we need to get the amortization of the discount by comparing the interest expense with the fixed interest payment. How much is the fixed interest payment? Face value is 4 million, stated rate is 9%, but we will be using 4.5%, which is 1/2 of the 9%. 1/2 because again, it is semi-annual. Okay, so 4 million times 4.5%, you would get 180. And then our interest expense was 184. So that means there's an amortization of the discount amounting to 4,000. Okay. And then initial discount was 320. And then the amortization of the discount is 4,000. So 320 minus 4,000. We'll have 316, which will now serve as the updated balance of the discount, the unamortized discount, or the remaining discount as of July 1, 2022. Then with the 316, we can already compute for the carrying amount. All we have to do is to deduct the 316,000 from the 4 million. The 4 million is the face value. The 316,000 is the remaining unamortized discount. Okay. Since we already have the carrying amount, all we have to do is to compare the carrying amount with the retirement price. But before that, alternative solution. How else can we arrive at 3,684,000? We can begin with the previous carrying amount. How much was the previous carrying amount? It was 3,680,000. How did we get the 3,680,000? That's the Face value 4 million minus the unamortized discount as of January 1 amounting to 320,000. Okay, so 3,680,000 plus the amortization for the first half of the year in the amount of 4,000, we would get 3,684,000. Now we will compare the 3,684,000 with the retirement price. The retirement price is 103%. Okay, so 4 million times 1.03, you would get 4,120,000. Okay, you paid 4,120,000 for a liability with a balance of 3,684,000. That means you will have a loss of 436,000, and that will be the answer, alpha. Next, problem 6-25. On January 1, 2022, Angel Company issued 5-year 5 million bonds payable with face amount of 1,000 per bond for 5,380,000. So that means there is a premium payable annually. On June 30, 2023, the entity retired 2 million bonds at 96 plus accrued interest. The entity used the interest method. Okay. The retirement happened in 2023, so we will have to update it by end of 2022 and by June 30, 2023. Okay. We will begin with, I hope you can follow already without me having to be very descriptive of the amounts. We begin with 5,380,000. We multiply 5,380,000 by the effective interest rate of 10%. So the interest expense is 538,000. Compare the 538,000 with the fixed interest payment, which is computed by multiplying the face value with the stated interest rate. The face value is 5 million, and then the stated interest rate is 12%. So that means the fixed interest payment is 600,000, but the interest expense is only 538,000. Okay, so there's the premium will be amortized in the amount of 62,000, which is the difference between the 600,000 fixed interest payment and the interest expense of 538,000 for the year 2022. What do we do with the 62,000? We will deduct this from the initial premium. How much was the premium at the start of the year? It is 380,000. Okay, 380,000 minus the amortization for the first year of 620,000 for 62,000. The remaining premium after 2022 will just be 318,000. With this, we will add the 318,000 with the 5 million face amount. That means the carrying amount on December 31, 2022 would be 5 million plus 318,000. That will give you 5,318,000. Okay. Alternative solution, you use the previous carrying amount, which is 5,380,000, and then you deduct the amortization of the premium in the amount of 62,000. You would still arrive at 5,318,000. Okay. Now we'll have to continue to June 30, 2023. Okay. With this one class, what I suggest we do is to split the bond class into the portion that will be retired and the portion that will not be retired. Okay. By the end of December 31, 2022, the balance of the 5 million bond is 5,318,000. We know that by June 30, 2,000 out of the 5,000 bonds will be retired. So essentially, that's 40%, while the 60% will continue. So what I want us to do is to split the 5,318,000 between the 2,000 that will be retired and the 3,000 that will not be retired. Okay, so I'll multiply 5,318 by 40%, which is 2,000, which is equal to 2,000 divided by 5,000. And on the other hand, I will also multiply 5,318 by 60%, representing the portion that of the bonds that will not be retired. Okay, and with this, I want us to proceed with the amortization of this portion separately, class. Okay, so the carrying amount of the bonds that will be retired at the middle of the second year would be 2,127,200. Okay, to update this one, we'll have to compute for the interest expense. 2,127,200 multiplied by 10% effective interest rate, but we will have to multiply it by 1/2 also, because the the bond will only produce interest until June 30, because by then it is already retired. Okay, or simply multiply the 2,127,200 by 5%. Next, compare this with the supposed fixed interest attributable to this portion. 2 million bond times 6%. 6% only, not 12%, because again, we are only computing up to June 30. Okay, so 2 million times 6%. That's 120,000. Our interest expense was only 106,000, so there will be an amortization on the premium on this portion amounting to 13,640. That is the difference between the accrued interest of 120,000 and the interest expense of 106,360. Again, that's 120,000 interest payable and the interest expense of 106,360. And then we deduct this 13,640 from the premium on this 2 million bond. How much is the premium on this 2 million bond? The bond is only 2 million, but it had a carrying amount of 2 million 127,200. Okay, so that means the premium on this portion was 127,200. Deduct the amortization and the premium from 127,200. The remaining premium on this portion will just be 113,560. Okay, and this will now lead us to the carrying amount of the portion of the bonds that were retired by the middle of 2023. Okay, the face value is 2 million. You add the remaining premium on this portion of the total bonds, you would get 2,112,000 113,560. Okay, and then alternative solution, the 2,127,200 minus the amortization this year of 13,640. By the way, again, the unamortized premium on the 2 million portion is 113,560. So the carrying amount then on June 30, 2023 of the bond that is to be retired is 2,113,560. Now we'll have to compare this with the retirement price. The retirement price is 96. Okay, so So 2 million times 96%, that will give us our retirement price. Okay, so the carrying amount of 2,113,560 minus the retirement price of 1,920,000, it will give us a gain of 193,560. Okay. Let's proceed to question number 2. This time, this is pertaining to the 3 million portion. Okay. As what we've computed earlier, the carrying amount as of the start of 2023 of the 3 million portion is 3 million 190,800. First thing we need to do to get its carrying amount at the end of the year would be to get the interest expense. Interest expense would simply be 3,190,800 times the effective interest rate of 10%. We would get 319,080. Multiply this one with the fixed interest payment of 3 million times 12%, we would get 360,000. Okay, so interest payment is 360,000. The interest expense was 319,080. That means there will be an amortization on the premium amounting to 40,920. And this 40,920 will be deducted from the balance of the premium as of the start of 2023. Since the carrying amount at the start of 2023 of this 3 million bond is 3,190,800, that means we had a premium of 190,800. Okay, so we will deduct the 40,920 amortization for the year from the starting premium for the year of 190,800. So the remaining premium at the end of 2023 would be 149,800. That is 190,800 minus 40,920. And since we already have our updated premium, all we have to do is to add that with our face value of 3 million. Okay, so 3 million plus the unamortized premium of 149,880, the carrying amount would be 3,149,880. Alternative solution, we begin with 3,190,800, the carrying amount of this portion at the start of the year, the start of 2023, and then just deduct the amortization of the premium for the year, which was 40,920. 40,920. We would still get 3,149,880. Okay, and that already gives us our answer. Proceeding to problem 6-26 and 6-27. Essentially, this is just a test on whether or not you know which factors to use. Okay, so if you're in problem 6-26, you're dealing with a 10-year bond that will have a maturity value of 5 million, which will require payment of 8% interest annually. So you will have two sets of cash flows here, interest payment of 8% and principal repayment of 5 million. The 5 million repayment will happen after 10 years. The interest payment will happen every year at the end of each year. Okay, so first compute for the periodic interest payment. How much is the periodic interest payment? You multiply the stated rate of 8% with 5 million, you would get 400,000. So every year for the next 10 years, you will be paying interest of 400,000. Okay, and by the end of the 10th year, you will be paying 5 million. You will have to get the present value of those two sets of cash flows, and you will be able to get the fair value or the present value. Okay, and for the 5 million, you will be using the PV lump sum factor or the 0.3855 because it is a singular cash flow. Okay, let's do that. 5 million times 0.3855. Okay, you would get 1,927,500. But that is not yet the answer because you will also need the present value of the 10 400,000s that you will be paying. Okay, and to get the present value of 10 sets of 400,000, you would be needing an ordinary annuity factor, which would be the one given in the problem, which is 6.145. So you multiply the periodic interest payment of 400,000 with the annuity factor of 6.415. You would get 2,000,000 566,000. You add this one with the 191,927,500 we computed earlier, you would get 4,000,000. Wait, calculation is wrong. 2,000,000. It's 6,145, not 6,415. 6.145. Okay. So 400,000 times 6.145 will give you 2,458,000. We add that with the 1,927,500, we would get total present value 4,385,500. The answer there would be delta. Okay, last problem, we have 6-27. 6-27. What amount should be reported as issue price? We're dealing with a 5 million bond with a term of 10 years with a stated rate of 6%, and then interest payment annually. Okay. Again, still two sets of cash flows class, principal payment and interest payment. Principal payment will happen after 10 years. So you will be using the present value lump sum factor. Okay, and of course, you will be using the factors under 9% because you will be using the effective rate or the yield rate. So you multiply 5 million times 0.422, you would get 2,110,000. But that is not yet the answer because you will still need to include the present value of all the interest that you will be paying. Okay, you will be paying 10 sets of interest annually in the amount of annual interest is 5 million times 6%. That is 300,000. So you multiply the 300,000 with the present value annuity factor, since it is a series of cash flow, a periodic cash flow. 300,000, again, still use the 9% factor. So 300,000 times 6.418. You will get 1,925,400. You add that with the 2,110,000 we computed earlier, you would get 4,035,400, which will be the total present value or the issue price of the bonds. Okay, the answer there would be Charlie. So that would be all. We've covered already the topics included in to be included in the examination.